Hey everyone, me Kevin here. In this video, I'm going to talk about the biggest danger for the end of 2020. I'm going to start with chapter 1. We're going to talk about market moving catalysts that we have ahead of us. Both good catalysts, things that make the market go up, and bad catalysts, things that help the market go down. Then in chapter 2, I'm going to talk about the biggest stock and housing market danger that we all collectively face. And then chapter 3, I'm going to talk about my suggestions in terms of what to do. So let's get right into the discussion right after mentioning that you should check out the amazing holiday sale that we've got going on the programs on real estate investing and stock investing and access to the private live streams every day the market is open. Linked down below, and you can always email me for a bundle at kevin@meetkevin.com. Okay, let's get started. Chapter 1, the biggest catalyst we have ahead of us. We've got quite a few of them. Well, to me, the biggest one out of all of them is the fact that we've only got 13 and a half trading days left in 2020. That means I expect a record volatility at the end of this year. We're going to see a ton of profit taking for hedge funds taking money out of the market and going, haha, look at the gains I locked in for 2020. This is going to be sweet clout for 2021. But at the same time, as you got hedge funds potentially taking money out to take profits, you might have a lot of people with retirement money flowing into the market because they've been sitting on the sidelines. And maybe they finally decide to get in 2020 before the year is over. We've only got 13 and a half days left to do that. In fact, Citibank is telling its customers to get 100% invested. There's this other dude, Jeff Stout from Capital Wealth. He's a chief investment officer. And he says, look, Citibank is right. Get 100% invested before the end of the year. He says, look, secular bull markets, his words, okay, tend to last 18 to 20 years. I think people are being way too cautious here. I think people are underinvested. If we get more people like this, we get a bunch of people flooding money into the marketplace, then it's kind of like, okay, well, what's going to be more damaging? Hedge funds potentially taking profits, or people flooding into the market? Is the market going to go up? Well, I think a lot of that has to do with what are hedge funds going to do? Well, I think if hedge funds do take profits, big, institutional investors take profits, I wouldn't be surprised if they just put the money right back into the stock market. The reason for that is usually we hear about the end of the year rotation into bonds, right? Hedge funds are like, oh, okay, we got to maintain our 60-40 split between stocks and bonds. But the reality is a lot of hedge funds might decide here in 2020 that, hey, usually we go over to bonds. Oh, but wait, bond yields are garbage. That's because there's so much frickin' money in the system that bonds have gotten so expensive and their yields have gotten low. Bottom line, hedge funds might not move into bonds. They could literally take their profits and just move right back into the stock market, which means now you got hedge funds staying in the stock market. You've got people funding retirement accounts moving into the stock market. Maybe you got people on the sidelines finally moving back into the stock market because investment advisors are like, get invested. The party's over here. Everybody get in. It can't go wrong. So you potentially will have a very volatile next 13 and a half trading days, but you'll also potentially see the biggest inflow of money that we've ever seen before into the stock market, which is crazy to think about because the market's already ridiculously high. But you want to know what's also ridiculous? The fact that 20% of all the money that exists in the world has been created in 2020. Yeah, 1/5 of all of the money that exists. So $20 out of every $100 exists, according to The Economist, was created in 2020, thanks to Federal Reserve stimulus money printing, ECB money printing, Japanese money printing, Asia markets money printing, and China, you name it. Everybody's been going brrr, which is a big tell that it wouldn't be a surprise for us to see the market move pretty substantially. Maybe not necessarily in the next 13 and a half days, but the capacity is there. People have a lot of wealth and cash sitting on the sidelines, which is certainly a different story. If you make less than $40,000 a year or you're unemployed, then you're screwed and you're getting left behind. Thank Congress for that. They suck. Rich are getting rich, poor are getting poor, right? But this is kind of generally what we see in capitalist societies. But what about the market itself? Like what are our expectations here, and what are our negative catalysts? Because so far, if we see record inflows, hedge funds don't rotate out, and we've got lots of money sitting on the sidelines because there is so much more cash, those are all really positive things. Those could prop the market up even more, which makes us think, wait, is this bubble territory, or is this just adjusting to a, dare I say it, new normal because there's so much extra cash around. Who knows? But what we do know is there are some negative catalysts on the horizon, and we're going to be playing that teeter-totter game of, okay, who's going to win? The positive catalysts that are going to send the market to the moon, or the negative ones that are going to create a lot of fear and uncertainty, and how do we play this game? Well, right now, the biggest negative catalyst is, well, Congress. That shouldn't be a surprise. Congress has a self-imposed deadline of passing a government funding and budget bill by the 18th, along with a rider stimulus package also by the 18th. But knowing Congress, this negotiation could easily spill over into Christmas week next week, or potentially even over into the New Year's Eve period. The longer Congress takes to come to a solution, my guess is the more people are going to be pretty hesitant about the market and will wait to re-enter the market until we get some more affirming catalysts. So we've got the good catalyst I've talked about. We've got the uncertainty catalyst of Congress. But then we also have the people that will sit on the sidelines waiting for Congress to do something. The odds are, if they do nothing, those people will not enter the market, and maybe we'll see the market move downwards. If they do act, the odds are the people on the sidelines might start moving into the market. Either way you look at it, it seems like people are ready to pull the trigger and get into the market in larger numbers than we've ever seen before. Now, of course, we do have a worst-case scenario. Let's do the worst case scenario because maybe this is what would actually lead to some people leaving the market and us seeing a decline in prices towards the end of the market. And that's the worst case scenario, which is we end 2020 without a budget or without a stimulus package. This would potentially happen because Congress might get to the end of this year and say, you know what, F it. Let's just wait until the January 5th runoff election. And if Democrats win both seats on January 5th, then Democrats will likely take complete control, and we likely won't see another stimulus package until Democrats can use their new power and clout to pressure Republicans into a deal until the end of January. This to me is probably worst case scenario, not necessarily that Democrats are in power, but just because all of a sudden now we're waiting even longer for a stimulus package, and we do more damage to our economy every single day that we don't get stimulus. This is probably going to create the biggest nervousness, but we might not see that nervousness materialize until January. But overall, I mean, generally when we see this kind of volatility and negativity, I see that as a wonderful buying opportunity. However, right now, it looks like a deal is at least relatively promising, that we will get something, like at least a $750 billion bridge deal. Maybe it doesn't include state and local government funding, but we get something to bridge unemployment, the eviction crisis, education, vaccine distribution, and so on. This would potentially mean that if we wanted to invest in 2020, we probably want to get in before that deal happens. Again, you've got this risk that the deal doesn't happen, and you have to wait until January, whether if Republicans maintain control of the Senate and we need to find a compromise in late January, or Democrats take control and we wait for a compromise in late January. Fine, that's going to create a potential buying opportunity there, but you're up against the fact that at any moment, Congress could say, we made a deal, and my guess is the market's going to jump faster than we can even react. As a result, there is a train of thought that it might make sense to get into the market and invested before Congress acts. Now, if you want to track what potentially could come out of this January 5th election, you can type into Google 538 poll Georgia Senate. It is a poll, though, so take it with a grain of salt. This poll does flip almost daily, but right now it looks like we're going to be stuck again with a Republican-controlled Senate as of the latest poll, although it seems like it depends who's doing the poll in terms of who's winning. But anyway, leading up through this and Congress acting, I think the next 13.5 days have some real potential for lots of this, a lot of this. But overall, it seems like the market is pricing in that Congress is going to get stimulus done. And we've got potentially record inflows and hedge fund money potentially staying in the market. Those are a lot of overall good things. Now, let's add to this. On December 15th and 16th, Tuesday and Wednesday, the Federal Reserve will hold their latest Federal Reserve Board meeting, and it will be the last one for the year. Now, while the market might be on pins and needles to see what the heck Jerome Powell is going to do, let me be upfront with you and say there is a 97.99997% chance that Jerome Powell is going to smooth our souls, our restless souls, and just say whatever he needs to do to make sure we believe the following things are true. Number one, the Fed will support the market with any tools they have available. Number two, the Fed will keep injecting $80+ billion per month into the markets through treasury bond purchases or mortgage-backed security purchases, basically printing money on demand. Oh, but it's digitally printed. He doesn't run out of ink because of that. And number three, he will do whatever he can to make sure that we think inflation will go up to 2% at some point in the future, but fear not, he won't raise rates until we have a sustained economic recovery. In other words, this week, especially come Wednesday when this press conference is expected, probably somewhere around 1:30, 2 p.m., something like that, from Federal Reserve, Chairman Jerome Powell, when this happens, I'm expecting our first bout of good news. And if this gets combined with Congress getting close to a deal, we're going to get double good news this week. So we could potentially be in a situation where by Wednesday, you've got Congress giving good news. Maybe, we'll see. If not, we could potentially get delayed, and that'll be, volatility inducing. But you're certainly going to get the Federal Reserve giving us all we want in terms of good news. My expectation is the market's going to be very excited about the fact that the vaccine's already getting distributed. We got FDA approval, actual approval, not just advisory recommendation, Friday night. That hasn't been priced into the market yet. I mean, maybe it has been priced into the market, but the market hasn't had a chance to react to it yet because the market hasn't been open. So far, I have to say, putting all these things together, it seems like, in a weird way, the market is leaning towards, hey, we might end up with a pretty green end of December here. Not saying we're not going to have volatility, but so far, the indicators of us potentially having a large crash, I think it's going to take some kind of black swan for us to actually see that. Kind of like when COVID first came around. And I don't know if we're going to get that. The biggest thing that I could say that's coming up that could create some real pain in the market is potentially between the 18th and 21st. See, on the 18th, we have quadruple witching day, and it's also the day that's right before Tesla joins the S&P 500. So, and then Monday, the 21st, Tesla actually joins the S&P 500. And I expect that maybe Thursday, the 17th through December 22nd is going to be a really interesting time, especially for Tesla. It could have broader market implications as well, because if we get a big sell-off at Tesla, then we're going to see the S&P 500 now go down. If Tesla drops a bunch, it's going to have like a 1.5% weight, and it's going to have enough muster to potentially start a tech sell-off, kind of like what we saw at the beginning of September. Tesla started selling off, people got scared, sold more Tesla off, boom, people ripped money out of all tech stocks. It was a crazy tech sell-off, all in September, and a lot of fingers point to Tesla right after the stock split for that. So, really, if we kind of compare some of these catalysts here, we've got, a good amount of pluses here, not too many crazy negatives. Now, in addition to the volatility we might see from Tesla, which we have no idea if Tesla's going to drop big after this inclusion date, I kind of think it will. It wouldn't surprise me to see Tesla 400 again, 420 again. We'll revisit those days again. Would not surprise me at all. And if that happens, I'll be shopping a big time because I think it'll be a big trader sell-off event. And we'll see how supply matches demand. But anyway, ignoring Tesla, what else do we have as maybe a negative catalyst? Well, maybe we have valuation chart. What do they always do? They always compare to the S&P 500. You get the S&P price to earnings ratios and all that. But wait a minute, the S&P 500 has a crap ton of tech companies in it. Look at the top 20%. It's all tech. Heck, probably 50% of the S&P 500 is tech weighted. And so the reality is, what does tech do? Well, tech is known for low earnings, and not only low earnings, but high R&D spend, probably contributing to low earnings. So you've got these tech companies that are investing in the future that give low earnings, which makes multiples look terribly out of whack in the S&P 500. And then the other 50% of the S&P 500, well, a lot of those are recovery stocks, which what's happening to them? Well, they've potentially got zero earnings. So yeah, of course the S&P 500 on the account of any particular or any even normal S&P 500 valuation chart is going to look overvalued. And then, even just forgetting the potential technical shifts that we're seeing in the S&P 500, consider the fact that if we do have 20% more money, it kind of makes sense that valuations are going to get stretched a little bit because you've got more dollars chasing a finite amount of stocks. So, things to think about here. Overall, when I average this, I get a little bit nervous about, well, we'll talk more about what I'm doing in my thoughts here in just a moment. But what I will say in the meantime is, first of all, if you've made this far, you deserve to get yourself life insurance in as little as 5 minutes and 4 free stocks. You go to the links down below, and in as little as 5 minutes, you can get life insurance in, well, by Apple Pay or Android paying for it, and you can get 4 free stocks worth up to $1,600. Just remember to deposit $100, because if you don't deposit $100, you won't get the second set of free stocks, which are the more expensive ones. You should be able to get at minimum $21 for free by depositing $100. It's like a 21% return on your money. Okay, so let's move on now to chapter 2, and that's what is basically the biggest risk and the danger facing the stock and housing market for us right now. Well, short of a black swan, given that, overall these things seem overwhelmingly positive, there is some uncertainty, right? We do have the uncertainty of Congress. The uncertainty of Congress, I suppose, should really be over here on the red side. So we do have some uncertainty, but those aren't necessarily guaranteed to be bad catalysts, whereas these seem to be mostly good catalysts. Be interesting. But what's the biggest risk factor that we face right now? And in my opinion, and this is going to sound a little oversimplified, but here I go. It's honestly, it's not investing. Look, number one, everyone watching this video should, and we're going to go deeper into this, okay? Again, I know that sounds simplistic. I don't want to lose you here because we're going to get into some really specific detail in terms of what you can do. But I personally think that everyone watching this video should be in a situation where they're considering getting pre-approved. So that way, at least if you're open to buying a deal in real estate, you're ready to do it. So that way you get an update on Zillow or Redfin, you're like, oh my gosh, that looks like a really good fixer-up or a really good multifamily deal. At least you've got the capacity to write an offer. It's not a bad idea. And look, yeah, no, I get it. Good deals might be far and few between, but this is exactly why you got to be ready to buy in real estate. So that way you could diversify out of stocks a little bit. And second, if you haven't gotten started investing in stocks yet, do that, or consider at least do this. Do me a favor. Transfer money over to your brokerage account. Stop keeping money sitting in your dumb checking account or your dumb savings account. I'd rather see you overdraft that crap than have a ton of money sitting there doing nothing. Get it over to your brokerage account. So that way, when and if an opportunity pops up, you don't have to sit around twiddling your thumbs, waiting for your money to transfer. It's there. You're ready to pull the trigger if an opportunity comes up. What could be an opportunity? Well, hello, if Tesla sells off big time and we start revisiting the 400s or the 300s, it's going to be an opportunity. You're going to want to buy that. I will. Now, I personally believe, but I could be wrong here, but this is my investing thesis now, and obviously you could take what you want with this. Usually when I say that we should invest, by the way, I get, I upset all of the bears who say, Kevin, you're an idiot, you're going to lose everything. Look, I've heard that for the last 10 years, and the opposite has been true, but that's fine. Everybody tries to criticize everyone. So no problem. I get it. I suppose that's human nature. I personally believe that the last 13 and a half trading days of 2020 could be, well, the last, again, depending on Congress, we'll see what happens in January. And if we get good news this week, then we don't have to worry about January. Anyway, these next 13 and a half trading days could be the last real opportunities to invest before the floodgates open, and everybody who's been waiting to get in the market and their mothers plow into the market with everything we've got. Like, that could potentially make 2021 investment returns pretty subpar unless you were already in the market before the floodgates opened up and everybody and their mother got in. There's still a lot of that fear and uncertainty on the sidelines right now where there are a lot of people who are heavily invested in cash or alternative assets. So that's a sign that the market, even though in some scenarios, like you look at like EVs or SPACs or whatever, the market might seem euphoric in some spots. The market might seem like it's at all-time highs. But in general, I would not say the market is euphoric. I don't think we have that kind of euphoria investing yet. We've certainly just been, especially the fact that we have 20% more money supply. To me, it's a sign that there's still room to go. We'll see. No guarantees the market's not going to crash. But personally, though, I'm not willing to sit around and wait for a crash. Reality is, if the market crashes, I'm going to do the same that I did in March. When I get paid, I buy more. And I won't be sad that I got in, earlier or later because you know what? You can't do anything about what's already happened. All you can do right now is look at your cash and decide, do I want to let my cash sit here for an opportunity that might not come, or do I want to get invested in the market? See, look, people told me since 2010, Kevin, there's going to be a double dip crash. You just wait. There's going to be a double dip. Shadow inventory of foreclosures are coming. And what did I do? Every step of the way, every time I heard this crap, I said, all right, bring it on. And I kept buying and buying and buying over and over and over again. There's a reason I now have an over $30 million investment portfolio. So this way, when all the bears I usually get in the comments that are like, just wait, Kevin, you're going to lose everything. Look, even if the market fell 50%, I'd still have a $15 million investing portfolio. So when the market fell in March, I cheered because there was an opportunity to buy cheaper. But it didn't mean I was going to sit around and miss out on all the potential gains that happened between 2010 and 2020 just because I was perfectly trying to time the market. And I encourage you to potentially consider getting a little bit heavier into the market. Just my POV, again, could be wrong, but I think there's a lot more certainty on the horizon than uncertainty, because here's the reality. What happens after these 13 and a half trading days? Well, the Tesla S&P 500 inclusion is over. The Congress, we will know, did Congress make a decision or not? We will know what the Federal Reserve's plans are. Are they going to increase their bond buying or not? We're going to know who's going to control the Senate on January 5th. We're going to know whether or not there's going to be an eviction crisis. We're going to know whether or not we have stimulus. So the reality is, once we know these things, we can plan, and the market likes to be able to plan and reacts to that, generally with optimism. It's when the market is fearful, which we have some leftover fear now. It's nothing like the fear we had before the election, or certainly not like what we had in March. Just look at the VIX, the volatility index. But even just forgetting about that, to me, what's the biggest mistake for 2020? Sitting on the sidelines and just waiting while all of the leftover fear evaporates. So my recommendation, where do you invest money now? Well, that's chapter 3. So to me, there are 4 things you should do in particular order, or in this particular order. Number 1, get your money set instead of in a dumb checking account. At the very least, the most basic form of investing, invest it into like a set of 4 to 5 different index funds tomorrow. Like all of your savings above and beyond a 2 to 3 month emergency fund, get it in. If you want to see a sample of this, go to metkevin.com/basket. There's just a sample of a basket of index funds you can invest in, or you can go to Wealthfront and check them out, and they sort of invest your money into a basket of index funds as well. Then, number 2, get pre-approved. Stop renting. At least be prepared to buy if a good deal comes up. If your neighbor comes over to you and like, Kevin, I just want to sell this house. I don't want to put it on the market. Do you want to buy it? Please just have a freaking pre-approval letter. And people are always like, Kevin, isn't the pre-approval letter going to expire? Who cares? So what? Like, this is how hard it is to get a new pre-approval letter. Hey, yo, Brian, can you write me a new pre-approval letter? I found a deal. Hey, no problem, Kevin. I'll send it right over. It's not that big of a deal. Oh, but Kevin, I need a new bank statement. Yeah, you would need that anyway if we went into escrow. It's not that big of a deal. Number 3, fund your Roth IRA, your HSA, and your 529 savings plan. Notice this order is very important. You got invested, you got your pre-approval letter to buy real estate, and then you're getting into the Roth, the HSA, and the 529 savings plans. More on that. We talk about that regularly in the investing course, in the money course mostly. But anyway, number 4. Now you could start, in my opinion, getting into something that's a little bit more catered to your risk tolerance. I personally like investing in something I call 1337 V17. Okay, so version 17, and I'm just finalizing this, but by the time this video is up, you'll be able to have the final version of it. But take a look at this. It's basically these pies through M1 Finance, where you will automatically get your money invested into these various different things. So if you put $1,000 into this pie, and I don't get paid for the money you have in these pies, if you sign up for M1 Finance, they give, I think, both of us a thank you. But the point is, like, I don't manage your money. I'm not collecting a fee off the money you invest in this. This is just a suggestion. Honestly, you could look at it and just bum the percentages if you want. But to me, here's an idea where if you invest $1,000, you put, $30 to $35 into Lemonade, Shift, Etsy, Pinterest, Peloton, Shopify, Beyond Meat, right? These are some of our larger consumer and retail stocks here. EVs, $100 into Tesla, 25 into NEO, 20 into Xpeng, 13 into Enphase. Just some examples here. DocuSign gets $27, Cloudflare, Fastly, they get $22, Zoom gets 17. So you can see how your $1,000 is actually getting diversified here for you with little work. PayPal, Square, they're getting $30. So to me, this is kind of a fun way to invest, because this way you put your money into something that's, this is heavily tech-centric, so I can't say it's extremely diversified, but it's certainly more diversified than just having one stock. The cool thing about that is if you load up, an investment account that you have 50 stocks in, for example, and it's all spread out like that, if you end up getting a big sell-off in Tesla and that thing drops like a rock, well, you're not going to get hit very hard because you're so diversified, again, relative to the tech space. But if you wanted to, you could always sell some of these, the index funds that you hold or this particular basket that you hold, and then specifically target buy Tesla if you wanted to on a buying opportunity. That way you're in the market, right? That's the big mistake. That's the whole point of this video, is you get in the market. If you're super nervous, get into the index funds, pick a few of them. And then that way, if the market falls and certain stocks sell off like crazy, the odds are all of your stocks are not going to sell off like crazy, and then you'll be able to shave and go buy.